A few times a year, I get a call from somebody I know who just woke up. They've been working hard, they've been working to grow their income, but they have nothing to show for it, and it's always the same story. Bro, Jaspreet, I've been working for the last 15 years. I've been working to grow my career, I make okay money, I have some nice stuff, but I have nothing in the bank. I have no investments, I have no wealth. What do I do? So this video is going to be dedicated to answering that question. How do you get started to build your wealth? Because from now on, when I get these calls, I'm just going to direct everyone to this video. Number one is get an income, but don't spend all of it. See, most of us think in terms of what I call net zero. You have $1,000 in the bank and now you think, what can this $1,000 buy me? Can I go on a vacation? Can I buy a nice watch? What can I do with this $1,000, which will take my bank account to zero? See, most of us think in this type of net zero spending. When we have money in the bank, we think, how do we spend it? But the quickest way to have more money is just to not spend all of your money. So the very first thing you got to do is understand when you earn money, you cannot spend all of it. This brings me to number two. You got to open up 3 different bank accounts. One bank account will hold the money that you can spend. This is your checkings account. One bank account will hold the money that you are going to invest, and one bank account will hold your savings. The reason why you want to have 3 separate bank accounts is so you don't accidentally spend your investment money, and so you don't accidentally buy a brand new TV with the money you're supposed to be saving. Now, this is where you want to automate this process because it's going to allow you to live your life and know how much money goes where. So what you can do is create a system where now every time you get paid, some of your money is going to go here, some of your money is going to go here, and some of your money is going to go here. That way you have a system where now it's automated. You make money, and some of your money is going to be the money you can spend. You know this is the only money you can use to go buy a car. This is the only money you can use to go out to eat at nice restaurants. This is the only money you can use to go on vacations. This is the money that you can use for your investments, whether it's stock market, whether it's the real estate, whether it's cryptocurrency, whether it's a business idea, whether it's paying down debt. This is your investment money. This is the money that you're saving for emergencies, and you don't use this money unless you run into a real emergency. Your kid breaks their arm, your car breaks down, you lose your job. This is what the savings money is for. Now, what I say is start with something simple, something like a 75-15-10 plan. Now, what this says is for every dollar that you earn, 75 cents is the maximum that you can spend. 15 cents is the minimum that you're investing. 10 cents is the minimum you're saving. This way, now you're paying yourself first before you go and make everybody else rich. What that means is when you go and spend this money, you go buy a nice car, you buy a handbag, you buy a watch, you go to eat at a restaurant, you go on a vacation, you're making other people rich because you're giving your money to somebody else. In these places, you're working to pay yourself first. Your wealth is not going to be built here. Your wealth is not built through your savings. This savings is just there to protect you against an emergency. You cannot outsave inflation, which means you cannot save your way to wealth. What that means is right now we have inflation. We have had inflation for a century, and we will continue to have inflation. The savings you have in your bank account is losing value to inflation. That means your savings are losing buying power. So why do we save money? We save money to protect us against emergencies. We don't save money to try to become wealthy. That's what you have to understand about the savings. Now, you should have a goal of how much money to save. You want to save somewhere generally between 3 months and 12 months worth of expenses. The amount of money is going to depend on where you are in life. If you don't mind taking on higher risk, if you don't have any financial responsibilities, you don't have kids, you don't have a spouse, well, then you might only want to save 3 months worth of expenses and invest the rest of the money. If you say, I want to be more protected with less risk, then maybe you want to save 6 months or 9 months or 12 months worth of expenses. This is going to depend on you and your risk tolerance and where you are in life. Now, once you figure out how much money you want to save, you save that much money and then you stop saving money because you don't want to just save your money to save it. You want to save your money strategically. That means save 3 to 12 months worth of expenses. Once you do that, then you stop saving money and you allocate the saving money towards your investments because this is where you become wealthy. This is the money you use to live your life. This is the money you use to go out to eat, the money you use to go on vacation, to go buy things. This is the money you use to become wealthy. This is where you're going to put money towards the actual investments that we can own assets that pay you for owning them. This is where your wealth is built. If you want to become wealthier, spend less money here, spend more money here. This is where you protect yourself so you don't have to worry about going into debt when an emergency happens. This is why you want to have 3 different bank accounts. That way it's separated, you know what money is for what, and then most banks will allow you to create some sort of automation like this completely free. Third, where do you put this money that you want to invest? That way you can actually become wealthy. And for the average person, where most people start investing is either in their 401k or their IRA. And let me start with this. Your 401k is not enough for you to retire and live financially free. It was never designed to be your sole retirement plan, and it should not be treated as your sole retirement plan. It's an okay place for you to start, but that's not where your investments should end. So you have your 401k or your IRA, which is fine, but you also want to invest money outside of just these retirement accounts. Now, before I talk about where you can invest this money outside of your retirement accounts, let's start by talking about the retirement accounts themselves. 401ks and 403bs work pretty much the same, so I'm going to categorize them together as this 401k section. And so let's talk about 401ks versus IRAs. So your 401k is issued by your employer versus IRAs are things that you go out and create yourself. Now, both of these are tax-deferred retirement accounts, meaning they are accounts which should give you some sort of tax benefits for using them. Now, the types of tax benefits you get are going to depend on whether you get a traditional or a Roth 401k or IRA. Now, before we talk about this, the one thing that I do want to mention is that when you invest your money into either one of these funds, well, you're going to pay a fee. So one thing that I want you to pay attention to is what is the expense ratio of the funds that you were investing your money in. And if you didn't know that your 401k or IRA has a fee, well, most people don't. NerdWallet did a study and they found that over 90% of Americans don't know what their 401k fees are. What is this fee? Well, when you put your money into a fund, an index fund, an ETF, all these funds have a fee for using them. Now, the fee that you pay is called the expense ratio. And this is where you want to know at least what the fee is to see if it's worth it or not. Generally, the lower the fee, the better it will be. Is that always the case? No, but generally that is the case. A 1% fee or 1% expense ratio will end up costing you about 28% of your entire investment portfolio over the course of your investment career. Why so much? Because it's not just a 1% fee that you pay today, it's a 1% fee that you pay each and every year on each and every dollar that you invest and each and every dollar that you earn. That's why these fees can be so expensive. So your $1 million investment portfolio can go down to $750,000 with a 1% fee if you don't know what the fee is and if you're paying a fee where you shouldn't. So the first thing I want you to do is just go and look at what your expense ratio is, and if it's really high, if it's above 0.4% or above 0.5%, I want you to consider if that fee is worth it or not. Now, once you know what you're actually investing in, the next question is, what are the different options that you have? Now, IRAs have a little bit of different options because IRAs have the potential for you to invest your money yourself. Like there are some IRAs that allow you to invest in real estate as well. So IRAs have a little bit more flexibility than 401ks, but generally the difference between a traditional 401k or IRA versus a Roth 401k or IRA is when you are taxed. So a traditional 401k and IRA, the way it works is you make money, you put it into this investment portfolio, and then you pay taxes at the end. So you pay taxes when you pull the money out when you enter retirement. So you make the money, it goes here, and then the rest of your income is taxed. So you get to avoid some of the taxes today, and then you pay taxes later on. That's how it works with a traditional 401k and IRA. With a Roth, the way it works, you generate this income right now, you pay taxes, and then you take this after-tax income and you put it into your investment. That's supposed to be an arrow showing that your money is growing. But you make money, you pay taxes, and then you take this after-tax income and you put it into this Roth 401k or Roth IRA. Now, the question is, which one do you do? And this is going to depend on what you believe is going to happen in the future. So the reason why some people like this traditional 401k or IRA is because they say, when I'm old, I'm not going to have a job and I'm not going to have an income. So my tax rates are going to be lower because I'm not going to have any money. So when I pull my money out later, I'm going to have a lower tax rate. On the Roth side, what people are saying is, well, I hope that I have a bigger income when I'm older because I'm investing my money, I'm working on my business, I'm working on whatever, so I can have our money. Or I'm also concerned where tax rates are going. I see where our national debt is. I see the issues with our economic health, and I see where our country is going. And because of that, I think tax rates are rising. So I'd rather pay taxes today and not have to worry about where tax rates go in the future. So I'm going to take the Roth. Now you got to decide which side you're on, and because of that, which one would you pick? So the Roth gives you a little bit more certainty on the tax side because you have to pay the taxes today, versus the traditional, you don't have to pay taxes today. You have more money that goes into your investment portfolio today, but then the amount of taxes you're going to pay in the future is going to be a question mark. This is where you have to make the decision of which one you think is better. And with the Roth stuff, this has to go more onto the economic side of what's happening in the economy and our national debt. Those are the types of things that we cover in Market Briefs, which is my free financial newsletter. If you haven't joined Market Briefs yet, it's an easy way for you to stay up to date on what's happening in the financial markets and our economy. You can read Market Briefs for free for 5 minutes or less every morning because my team is breaking down what's happening in the economy, the housing market, the stock market, crypto, and the global economy into a fun, witty, and easy to read email. So if you haven't joined Market Briefs yet, I'll put the link to how you can join for free down in the description below. So now what we talked about is when you earn money, you can't spend all your money. You got to be smarter here. Second, when it comes to investing in money, the first thing you can do is look at these retirement accounts, a Roth or traditional 401k or IRA. Then we also talked about the savings and why you don't want to save all your money. But those investment, the retirement accounts that we just talked about, is just the first way that you want to start investing. That shouldn't be the only way that you start investing. Now, outside of your retirement accounts, you have two different ways that you can start investing. What I like to call passive investing and what I like to call active investing. Let me start by talking about passive investing, which is now the fourth thing that you need to be doing. See, when most people think about investing their money, they think, how do I find the next Amazon? Or how do I find the next Microsoft before it becomes the next big thing? But for the vast majority of people, that's not how you should be investing, and that's not how you need to be investing, even if you want to be a millionaire investor. There are ways for you to create automatic passive investments that don't take much or any time on your end, that are just simple things that you set up, and now you don't have to worry about it, and you're getting exposure to the market. Because what we've seen happen over the last century is that the stock market has grown by an average of 7 to 10% a year. That doesn't mean that the stock market always goes up by 7 to 10% a year. That means on average over the long run, that's how much the stock market has grown by. Now the problem is most people who try to invest their money in the stock market end up losing money, which doesn't really make much sense. The stock market is growing by 7 to 10% a year, and most people are losing money in the market. What's going on here? Well, when most people try to actually make money in the market, they're trying to find the next hot stock, and they don't know how to research a company. They end up overpaying for the company, and then they sell this investment for a big loss, or they just have no idea what they're doing. Versus if you just put your money into the market and get a broader exposure to the market, it's an easier way for you to invest because you don't have to individually research each company, and it can be completely passive and automatic on your side. How does this work? Well, instead of investing in individual companies, you can invest in a fund. There's a few different types of funds. You have index funds, mutual funds, and ETFs. Index funds, mutual funds, and ETFs are three different types of funds that give you exposure not to one company, but to a basket of companies. So what that means now is you're investing into a fund that is managed by something else, either a computer or a person that will then make sure that your investment portfolio is working to give you exposure to the investments that you thought that you were getting. So what does that mean? Well, you can invest into the total stock market. There are funds that give you exposure to the total stock market. There are funds that give you exposure to the largest 500 companies in the stock market. This is called the S&P 500. There are funds that give you exposure to tech stocks. There are funds that give you exposure to healthcare stocks. There are funds that give you exposure to real estate companies. So now you can start thinking, what do I want exposure to? Do I just want exposure to the broad stock market? Do I want exposure to the largest companies in the stock market? Do I want exposure to a particular sector? Once you know that, now you can just find the right fund that will give you that exposure. Now the big difference between something like an index fund and a mutual fund are the fees, because the fees are going to depend on how much work is required to manage the fund. Index funds are generally passively managed versus mutual funds are generally actively managed. What that means is actively managed funds are managed by a person. Passively managed funds, because they're managed by a computer, are much lower fees, meaning much cheaper to invest in than an actively managed fund, because now you're trying to bet that this person who charges a higher fee will now get better returns. Now, what we've seen happen throughout the last number of decades is that generally over the long term, this money manager cannot outperform the passively managed funds that are giving you exposure to the market once you factor in the fees. So sometimes these fees will be worth it, most of the times not. ETFs, on the other hand, can be either passively managed or actively managed, but the biggest difference between an ETF and an index fund or a mutual fund is how easily you can access an ETF, because ETFs trade just like any other stock. You can buy and sell a stock within the same second or within the same minute, versus most index funds and mutual funds you cannot. Most mutual funds and index funds have other restrictions, like limitations on how much money you have to invest. Some might require $2,000 to start investing into either one of these. They might have limits to how often you can trade them. You might only be able to buy it or sell it once in a day. ETFs, on the other hand, don't have those restrictions. You can buy or sell an ETF whenever you want, as long as the market is open. A couple examples, something like VTI. This is an ETF created by an investment institution called Vanguard, which gives you exposure to the entire stock market. So when you invest in VTI, you're investing in the total stock market. Another one would be something like SPY. Now, as a little bit of a disclaimer, while I'm giving you these as examples, I'm not telling you what to invest in. You need to do your own research because one, investing has risks, and two, you are never guaranteed to make money when you invest. You might even lose money, which is why you need to do your own due diligence and never blindly trust a random guy on YouTube. SPY is another ETF that gives you exposure to the S&P 500. The S&P 500 are the largest 500 companies in the stock market. You can invest in an ETF like DIA. DIA is an ETF that gives you exposure to the Dow Jones. You might have heard of the Dow Jones. Well, if you invest in DIA, now you're investing in the Dow Jones. You can also invest in an ETF like QQQ. QQQ is an ETF that gives you exposure to the NASDAQ. So now these are different types of ETFs that give exposure to different indexes, and there are so many different ETFs out there. You just have to figure out first what it is that you want to invest in, then see the different options that there are. The easiest way to do that is just to do a quick Google search. There are a lot of different options out there. This is not even close to a comprehensive list, but it's a way for you to start thinking about what it is that you want to invest in. Now, when we talk about creating an automatic passive investment, what you can do is say, all right, I want to take a piece or all of this investment portfolio that I have, and now I want it to be automatically invested into my passive investments. This is where now you have to decide how involved you want to be with your investments. Do you just want to invest your money and not have to think about it? Well, then maybe you invest all of this money into your passive investments. If you want to be more involved with your money, maybe you don't do any passive investing, or maybe it's a hybrid. Me personally, I invest my money in 5 places. I invest my money into my own businesses and startups that I invest in. I invest my money into physical real estate. I invest my money into stocks. I invest some money into crypto, and I invest some money into physical gold. When it comes to my stock market investments, I have my passive investments, like we just talked about, and I also have my active investments, which we're going to talk about in just a second. So you got to decide, what do you want to invest in and how do you want to invest in it. In these passive investments, it can be completely passive and automatic, but the key here for you to succeed as a passive investor is you want to be investing for the long term, the next number of decades, not just the next number of years or the next number of months. Passive investing is a long-term game. That's where you're going to see the real wealth, and the way that you win is every week or every 2 weeks or at least every month. You want to be consistently, passively, and automatically investing your money into the markets. There are brokerages out there that will automate the whole thing for you, that are free of charge, that will allow you to invest your money into your passive investments, and they will do it without you having to manually do it. It's completely passive, so you turn it on and it will happen by itself. I use a platform called M1 Finance. They are an affiliate from Minority Mindset. They've been a previous sponsor from Minority Mindset, meaning if you use them, you will get compensated. But for M1 Finance, I have my link down in the description. The reason why I like M1 Finance is just because it's so simple to use, and because, well, they specialize in this type of passive investing. So for me, every Wednesday, money leaves my checking account and is automatically invested. Why Wednesdays? Because I used to have it on Fridays and I used to have it on Mondays, but many federal holidays fall on Fridays, so the markets would be closed, which meant the money was not being invested on those days. So I just picked the middle of the week because now it's less likely to be closed because of a federal holiday. So no secret sauce or science behind the day, but for me, I have it so every week I have money leaving my checking account and it's automatically being invested into my portfolio of ETFs. That way now I have my passive investing system working to help build wealth on the side. So now we talked about investing your money in retirement accounts. We talked about investing your money passively. Now let's talk about investing your money actively, which is the fifth thing that you need to understand is how do you invest your money passively? Now, there's a lot of different ways that you can do this. You can do this in the stock market. You could do this with real estate. You could do this with businesses. You could do this with really anything where now you are researching an investment, a particular investment. You're doing the work to find an investment, and you're not trying to flip it for a quick profit. That's trading. When we talk about active investing, I'm still talking about long-term investing because real wealth is built over the long term. You don't build real wealth in the short term. That's trading, that's speculating, that's gambling. I don't do that. So when we talk about active investing, I'm talking about investing money for the long term, but now you're looking for individual investments that you can invest in based off of your research that you want to hold on to for the long term. Now this could be stocks. You're looking for the right company that you believe will be a good investment. But this comes with higher risk. Like you could go out and invest in the Amazon Corporation. That is an active investment. Now, if you invest in Amazon for the long term and Amazon takes over the world, well, now you're going to see a big return on your investment because that means that Amazon's going to have bigger profits, their stock prices go up, and you're going to make more money. But if the CEO of Amazon runs the company into the ground and now Amazon is losing money and they declare bankruptcy, well, now your investment goes down to zero and you lose all of your money. So you have higher risk, higher potential return, but you also have the potential to lose more money. That is how active investing works. So the way it works in the stock market is now you are looking for individual companies. This means now you're looking for good companies. You're going to be listening to the earnings calls. You're going to be valuing the companies, keeping up with the company, and then see if it's a good investment for you. This is not how most people should be investing, but if it's something that interests you, then this is something that you can do. I like it, which is why I do active investing in the stock market and passive investing. I also actively invest my money in real estate. When I talk about actively investing my money in real estate, I'm not talking about buying a home for me to live in. I'm talking about buying a rental property. It might be a home to rent out to somebody else. It might be an apartment complex. The reason why is because now when I invest in real estate, I'm getting three things. Number one, I can get cash flow. Because now I'm working to buy this property, an apartment complex, a home, that way I can rent it out to somebody else. Now when I can do that, I'm getting cash flow because now the rent that I'm getting should cover the expenses. It should cover the property taxes, the insurance, the maintenance, the management fees, and the vacancy costs. That way now every single month is putting some money in my pocket. That's why I like investing in real estate because it gives me that sort of cash flow. The second benefit of real estate investing is it gives you tax breaks. As an attorney who is not your attorney, I can tell you that real estate offers some of the biggest and best tax breaks that our tax code has to offer. This is why so many wealthy people love investing in real estate. So when people get money, they like to put it in these real estate investments because now the real estate will give you cash flow and it will protect your wealth with tax breaks. And number three is it gives you a hard asset. Because when you take your cash and you save it in the bank, your savings are losing value to inflation. Versus with real estate, over the long term, we have seen real estate values rise. Why? Well, part of the reason is because the cash that we're using to buy the real estate is dropping in value. And second is because if you're investing in real estate in a good area and the demand to be in that area is growing, well, now the value of the real estate is also rising. A third way that you can actively invest your money is to invest in startups. Now, this has become much more accessible now thanks to the internet, but it's still very risky. What you have to understand with the startups is that 90% of startups will fail. Meaning, most of your startup investments will go down to zero. That's one of the pros and cons of startup investing is that you're probably going to lose money. But if you hit your money on a good startup, well, now you can make all of your money back plus more because you made a good investment. So this type of startup investing is high risk, high potential reward. You got to understand that going in, and you have to understand that most of the time you will lose money. Even when I invest in startups, I know that most of the startups that I work with and that I invest in are going to go bankrupt or they're going to go nowhere. That's just how the statistics work. Now, there are some platforms online that make startup investing like this much more accessible. One of them is WeFunder, one of them is Republic, one of them is Start Engine. Do your own research, see which one you like, and I gotta let you know that I personally am an investor in the WeFunder platform, but do your own research, see the ones that you like the best. Now, the advantage of these new platforms to allow you to invest in startups is that now you can start investing in startups with as little as $100 versus before, if you wanted to invest in startup companies, you would need hundreds of thousands of dollars typically to get started because then you need the money to find the companies and then to fund the companies and then to manage your investments as well. And the last active investment that I want to highlight is paying down your debt. Because paying down your debt is an investment because it's going to give you a guaranteed return. If you have a 6% mortgage rate and you take $10,000 and you pay off this mortgage rate, well, you get a guaranteed 6% return on that money because that's 6% that you don't have to pay in interest on that principal. Just one thing that I want to remind you, that when you do pay off your debt early, you want to make sure that when you pay this payment, that you want it to apply to your principal balance, not your future payments, because if you apply it to your future payments, well, you're just paying next month's payment early, versus when you apply it to the principal, that's less money that you have to keep paying interest on. So now this is where you have to make the decision. Would you rather pay down debt right now, or would you rather use your money to invest it into something that's going to grow? And this is going to depend on your lifestyle, it's going to depend on your risk tolerance, and it's going to depend on what type of goals that you have. If you want to live big and you want to go for it all, well, then you got to take more risks with your money. If you just want to be financially free and not have to worry about money and never have to stress about money again, well, then you can work to pay down your debt, because that's going to relieve a lot of that financial stress. So now we talked about how to automate your finances. We talked about why you need to live below your means. We talked about different ways to invest your money. You can invest your money into retirement accounts. You can invest your money passively. You can invest your money actively. And we talked about why you need to save your money strategically. And this brings us to number 6. Let's differentiate assets and liabilities and needs versus wants. Once you get to this point, usually what happens is people get excited. They start to see the prospects and the potential of what happens when you invest your money, because now you can see the potential growth of your money, the potential growth of your wealth, and now you get excited. I want to do more of this. Well, if you want to do more of this, you're going to need more money to invest. And the first way that you can get more money to invest is just to spend less money. And the first way to do that is to understand the difference between an asset and a liability. Because an asset is something that puts money in your pocket. It's something that you buy for the sole purpose of making money, versus a liability is something that takes money away from you. And what ends up happening so many times is when we go to spend money, is we justify liabilities as assets. We call these things which are money pits assets, so we can justify spending more money. What's an example of this? Your car. Many times people talk about their car being an asset. I don't know why, but cars are known to be liabilities. They lose value. So if you're going to be buying a car, you want to make sure you can buy a car that you can afford comfortably, ideally with cash, that we don't have to finance something that's losing you money. Now, many people hear that and say, wait, what do you mean, Jaspreet? How am I going to afford the BMW in my driveway with cash? Well, maybe you shouldn't have a BMW, because that BMW, which is costing you $500 to $700 a month, is eating away at your future wealth. Instead of spending $500 to $700 a month for the rest of your life on a car, because as soon as you finish the payments on this, you're going to go and buy a nicer car and then start the payments all over again. So you end up paying payments for the rest of your life on your car. Instead of doing that, go and buy a $7,000 Toyota Camry or Toyota Corolla with cash. I know it is a downgrade from your BMW, but now you're no longer have to make the payments. Now that you don't have to make the payments, that's $500 to $700 you can put towards your investments. It's the same with your house. Everybody, I used to be a real estate salesperson. Everybody talks about how the home that you live in is an asset, it's an investment, it's the biggest investment that you're ever going to make. Well, in reality, for the vast majority of people, your house isn't an asset. Actually, it's a money pit. Your house is only an asset if you can sell it for a profit. But that assumes that you're going to be able to sell it for a profit. That assumes that the economy is going to be strong when it goes time for you to sell it. And that assumes that you're not going to have to sell your home when you're in a recession in the housing market. And that also assumes that you're going to have to sell the home that you live in order to actually get the money out from your home. Your home is a money pit until it becomes an asset, if it ever becomes an asset. And until you get to that point, it's costing you money every single month. You have to pay for your mortgage, you got to pay for your property taxes, you got to pay for the water bill, you got to pay for the heat, you got to pay for the gas, and then you got to pay for the upgraded bathroom. You got to pay to upgrade the basement. You got to pay to upgrade the bedrooms. You got to pay for all the maintenance, and you got to pay for everything else until it comes time for you to sell. And when you keep believing that the home that you live in is an asset, it's so much easier to get you to spend more money on the home that you live in. Why would you live in a small home when you can live in a big home and build generational wealth in this big home, and then it becomes an even bigger money pit? When in reality, if you really want to build wealth, what you should be doing is taking that money and using it to buy a rental property. Using this money to buy more assets that are actually paying you to own them, because now you're buying these assets with the purpose of making money. You buy the home that you live in with the purpose of making memories. There's nothing wrong with owning a home. There's nothing wrong with having a big home. Make sure you can afford it first, and don't sacrifice your future wealth just so you can have a big home, because that big home is money that could be used here to give you even more wealth, which will allow you to buy an even bigger home in the future and not have to worry about the price. This is where now understanding an asset versus a liability, not justifying a liability as an asset just so you can drive bigger and have bigger, because yes, you need a car to get to and from work, you just want a BMW. You need a home to live, you just want a mansion. And understanding that difference, that way now you can prioritize this over this, will allow you to live bigger in the future. And the reason why this is so hard is because now people have to take a step back and say, you mean that I'm going to have to live smaller? What are people going to think? What are people going to say when they see me go from this lifestyle to a smaller lifestyle? People are going to think I lost my mind. Well, if you're so worried about what other people are going to think, it's going to be very hard for you to ever achieve any real wealth. And this is where you have to understand, what would you rather have? Would you rather have the wealth? Because wealth is built here, wealth is not built here. And in order to have the wealth here, you're going to have to make sacrifices here. And if you're not okay making that sacrifice, well, you're going to continue making everybody else rich. Because when you spend this money, you're making other people rich. When you spend this money, you're making yourself rich. And what I'm saying is make yourself rich before you make everybody else rich. Nothing wrong with having nice things. Nothing wrong with having luxury things. Nothing wrong with having expensive things. Just make sure you can afford it first. That means take care of yourself and make yourself rich before you make everybody else rich. Going along with that is number 7, which is stop living off of debt. See, so many people in America live in this consumerism culture where it's completely normal to spend money, not based off of how much money you have in the bank, but based off of how much money you can qualify for, which means you make $1 to spend $2. This is why it's completely normal to have credit card debt. It's completely normal to finance your car. It's completely normal to go to the Gucci store, not have money to buy that $2,000 handbag, but then finance it with Gucci's new credit card or whatever they're offering, which means now you can buy things that you can't afford with money that's not yours. And now you're going to spend your next month's income and next year's income not buying more things, not building more wealth, but paying off your previous non-wealth building expenses. This is where the best thing for you to do when it comes to spending money is to not spend with debt unless it's something that's going to make you money. The only exception to this is your home, but for everything else, from your car to your groceries to everything in between, you should not be financing these things if it's not putting money in your pocket. And this can be hard, especially when you're in this culture where everybody finances everything. Why pay full price when you can pay it off in installments? Well, when you pay it off in installments, you don't feel the real pain of spending money today, even if it's 0% APR. And most people say, why would I not want to pay 0% APR on my $1,000 phone and pay it off over 18 months, because then I can just invest the money today? Because most people don't invest that $1,000 today. What they end up doing is they finance their phone with 0% APR over 18 months, and then they go out and they finance a laptop with 0% APR over 18 months, and then they go out and they finance a TV over 18 months with 0% APR. And now you spend way more money today than you would have if you actually spent that whole $1,000 today and you never end up actually investing that money. That's why instead of playing that payments game, instead of trying to keep up with the system, pay it off with cash, never have to worry about the payments, and make more money. That way you can actually afford what you want to buy and never have to worry about the price. And this even comes to your house, because what ends up happening to a lot of people when you are in a booming economy is you buy this home right here. You bought this home for, let's just say, $400,000. And now a number of years go by, the economy starts to boom, the housing market booms, and now you find out your home is worth $600,000. Well, again, this $600,000 doesn't really mean anything unless you sell the home, but now you don't have a home anymore. Or you can do a cash out refi, which sounds great. You can pull out $550,000 from your home, pay off your previous loan, and now you have $150,000 in cash in your pocket to do whatever you want. And then what do people do? They take this cash and they go out and they buy a boat. They go on some nice vacations. They buy a better car, because now you have this extra cash in the bank. Well, when you live off of your net worth, you're spending money that's invisible. Because then if you go into a recession, the housing market slows down, and then your home value goes back down to, let's just say, $400,000. Well, you took this cash and spent it. You have to pay this money back plus interest. But the asset that you used to finance it isn't worth as much as you thought. So now you're the one that's left with the debt. You're the one that's left with the payments, and you're the one that's left with all the fancy liabilities that aren't worth as much as you thought. This is where, if you're going to be spending money, buy what you can afford with cash. Don't use debt to buy anything unless you're buying it with the purpose to make money. If you're buying something that's going to make you money, now we can talk about using debt strategically. But if you're buying something that's not making you any money, don't use debt unless it's your own home. But even then, make sure you can afford the home that you're living in. That means afford the down payment and afford the monthly payment. That way it's not sacrificing your future wealth. You should still have money to invest, even though that you have this home that you have to pay for. Number 8, this is where things get really fun, because now you know how to spend your money the right way. You know how to invest your money the right way. And you know how to save your money the right way. And now you're gonna really start loving this whole financial education thing. You're gonna love this investing thing because you're building wealth. And your next question is, how do I do more of this? Well, if you want to fuel this financial education and you want to fuel this investments, that means you're gonna need more money. How do you earn more money? Because the more money you earn, the more money you're going to have to invest. And we already talked about how you can invest more by spending less, but I want to show you this little chart right here. Because what ends up happening to so many people is you say, okay, I'm earning $40,000 a year, and this is how much I'm investing. I'm investing $10,000 a year. And you say, you know what? I want to invest more money. So now you try to go from here to here. You try to go from investing $10,000 to $12,000 a month. And then you go from trying to invest $12,000 a month to $13,000 a month. You're trying to squeeze more pennies out of this pie, which can be good in the short term, but there's going to be a limit to how many pennies you can squeeze. There's going to be a limit to how much you can save, but there's no limit to how much you can earn. This is where I want you to remember a couple things. Number 1, a penny saved is just a penny. And 2, I want you to build a growth mindset and think bigger. If you want to be able to invest more money, you can also work to grow the pie, where now instead of earning $40,000, you're earning $400,000 a year. And if you invest that same ratio, now you're not investing $10,000, you're investing $100,000. And the first thing you're gonna say, I already know, is Jaspreet, my boss isn't going to give me a raise from $40,000 to $400,000, and you're 100% right. This is where you're going to have to be a little bit creative and start thinking outside of the box. Because as soon as you think that, oh, I could go from $40,000 to $400,000, now you're going to start thinking a little bit differently. And you're going to start acting a little bit differently, and you're going to start learning different things. Now you're going to start watching YouTube videos on how to earn more money. You'll start reading blogs on how to earn more money. You're going to start reading different books, and you're going to start absorbing different content and doing different things to earn more money. If you want to earn more money, you can do it from your job. You can try to get a raise or promotion. You can try to get a second job, or you can try to do something on the outside. You can try to create a side hustle. You can try to create your own business. You can try to create your own income. That way now you can earn more money, because there's no limit to how much money that you can earn. But there's a limit to how much money you can save. But in order for you to do that, you have to start thinking differently, and you have to believe that it's possible for you. Because if you don't believe it's possible, you're right. It's never going to be possible. But if you believe it's going to be possible, well, you're going to start thinking differently. And that's going to change your actions, and it's going to change what you learn, and that's going to change what you do. It's not going to happen overnight, but maybe over the next 10 years, you'll be able to 10x your income, because now you're working for something completely different. You're not just working for a raise at your job, you're working to really increase your wealth, because that will allow you to invest more money. Remember, the key here is, why are you earning more money? You're not just earning more money that way you can spend all of it. You're earning more money that way you have more money to invest. Number 9 is understand taxes. In America, as an attorney, I can tell you this, but I'm not your attorney, so make sure you talk to a professional in your area if you have specific questions. But in America, we have 3 different categories of income. You have earned income or ordinary income, you have portfolio income, and you have passive income. All income is not treated the same. Earned income is your W-2 income. This is the money you make from your job. Portfolio income is the money you make from your investments, your stock market investments. You buy a stock and you sell it for a profit more than a year later. Passive income is the income you get from your rental properties. Do you want to know which category of income has the highest tax rates and the lowest tax deductions? Well, it's this one right here. It's the income you make from your job. Because the way it works for most people is you go to work, you get paid, you pay taxes, and then you have to spend whatever's left. But things start to change if you're an investor or a business owner, because now the way it works is you earn money, you can spend money, and then you pay taxes on whatever's left. Our system is designed to benefit the investor and the business owner. Now, you don't have to go out and start a business. You can still take advantage of some of these systems by being an investor, but you have to understand how it works, that we can actually take advantage of it. See, when most people want to buy a phone, they want to buy a car, they want to buy a laptop, you have to earn money, pay taxes, and then with whatever money is left after paying taxes, you can use to buy a phone, your laptop, or your car. When you own a business, it can be a little bit different. Like for me, I need a phone to operate my business. I need a laptop to operate my business. I need a car for my business. So I make money, I spend my money on these things, These become tax write-offs, and I pay taxes on whatever money is left after spending my money on these items. It's completely different. And then when you earn money from your investments, well, your taxes are also going to be different. Like if a doctor earned $1 million from being a great surgeon, you might be left with half of that. $500,000 after paying for all of your federal taxes, your state taxes, and payroll taxes. But if an investor made $1 million for selling an investment for $1 million profit after owning it for a year, well, now your top tax rate today is 20%, meaning you're going to be left with $800,000 if you earn this money from an investment. Maybe a little bit under $800,000 depending on some of the other rules out there, but around $800,000. You keep $500,000 if you made that money as a doctor. You keep $800,000 if you made that money as an investor. This is why it pays to understand taxes and why you need a great tax advisor in your area, because our system is designed to benefit the investor and our system is designed to benefit business owners. Now, what does that mean? Well, now that you're becoming more financially educated, not only do you get the benefit of becoming more wealthy, you also get the benefit of the tax law. And finally, now number 10 is protect your wealth. This is where now you're working to build wealth, you're working to implement these systems, you're working to build a financial education. This is where you want to make sure you protect yourself. This means you have to talk to an estate planning attorney. That way you can build a plan for your wealth after you die. What's going to happen to your money after you die? If you don't create one of this, then it could be the government that decides where your money goes, and that could create a lot of conflict with families. So go talk to an attorney, talk about a will, talk about a trust, and go get something created. It's a little bit of a cost, but it will save a lot of headache for your family after you go. In addition to that, make sure you have the right insurances for yourself. This could be your health insurance, car insurance, home insurance, investors insurance. This for things like landlord's insurance. If you're a real estate investor, if you own a business, you want to make sure you have your own business insurance. There are so many different types of insurances out there. It sucks to pay for them, but it's a small price you pay for a huge peace of mind in the future, because if you get sued, well, now you're going to have to work to either settle the lawsuit or come to a conclusion with the lawsuit. And this is where you want to make sure you have insurance there to protect you. And of course, this is where you also want to make sure that you're also giving back. The more you have, the more you can do. And this could be giving back with money, this could be giving back with time, this could be giving back with knowledge. The more you have, the more you can help. So there you have it, the 10 steps to building wealth. If you know somebody on their financial education journey, please send this to them. That way they can get some guidance on how to grow in their financial education journey towards building wealth. I need a phone for my business, so I deducted my iPhone from my income. I had to go to San Diego last year, I had to go to Manhattan last year. I spent about 2 months in San Diego and about a month and a half in Manhattan last year. Both of those were expenses. I got to expense my travel, my flight, my Airbnb, my meals,